So we've been waiting for silver to break out again. That has happened as well. So it's been a very exciting year. What ultimately, though, is driving it is really hard to put your finger on. And they're net short. Well, we'll see what they are in the next survey. But I don't know, 40,000, 50,000 contracts of silver net short. Well, that's a couple 100 million ounces. So every dollar that silver goes up, that's a paper loss of a couple $100 million. Worry that those positions get so stretched and extreme that you start seeing some shenanigans to try to get the price back down. But for now, like I said, we seem to be doing okay.
In today's episode, Craig Hemke explains his predictions for gold prices in the coming year, noting that demand for gold has been unusually high, especially from central banks. He mentions that even though he initially thought gold would stay steady for the first half of 2023, prices broke out sooner than expected. This demand pushed gold prices up as more countries, especially those in developing regions, started purchasing large amounts of gold. According to Hemke, this steady buying by central banks shows that they see gold as a stable asset in uncertain economic times. Hemke also highlights the growing appeal of silver, which has recently shown signs of catching up to gold's gains. Silver often follows gold in terms of price movement, but its rise has been slower this year. He believes this catch-up is now happening, with silver seeing increased demand alongside gold. For Hemke, both metals have the potential for further price increases, driven by global economic uncertainty and strong buying interest, particularly from countries seeking alternatives to the US dollar. One of the key drivers Hemke sees behind the rise in gold prices is the high fiscal deficit in the United States. In August alone, the U.S. deficit reached $380 billion, which Hemke describes as out of control. This ballooning deficit creates a shaky financial outlook, leading more investors and countries to turn to gold as a reliable store of value. He suggests that if the U.S. economic situation worsens or if a recession hits, the deficit will grow even further, which would likely push gold prices even higher. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Going all the way back to January. I thought, by the time we get around to the Fed actually cutting rates, we'll probably have gone sideways for about the first 6 months of the year, and then we'll finally break out. We'll go to about 2,300, and that's maybe about the best we could expect, because as we entered the year, the talk was, the Fed's going to cut 6 or 7 times, and the dollar index was down around 100, and had you known then that those rate cut expectations were going to get trimmed back to basically zero by June or July, that the yield on the 10-year note was going to go up 50 basis points, that the dollar index was going to go up by 5 or 6%, you'd have thought, oh man, boy, we're in for a tough start to the year. And instead, gold takes off. And I'm first to admit, I was pleasantly surprised by that. Once it actually broke out of its 3.5-year range back on March the 1st, it was just off to the races. And then eventually the attention turned to silver, and why isn't silver moving to catch up? And then silver moved to catch up. Gold then goes sideways through the summertime, then breaks out again. And so we've been waiting for silver to break out again. That has happened as well. So it's been a very exciting year. What ultimately, though, is driving it is really hard to put your finger on. I think central bank gold demand is obviously a big driver, because this is going to be the third year in a row of record central bank demand for physical gold. And you can certainly see this across, whatever you want to call it, the developing nations, the BRICS, the global south, whatever. You can definitely see every month, India, Turkey, just go down the list. They're constantly adding gold. But I think we're starting now to get enough headlines, that people are paying attention to gold in the first, that, wow, look at that gold go. I wonder what's going on. But then you get news like the fiscal situation here in the U.S., Patrick. And I think this was an underappreciated moment about 6 weeks ago. the U.S. Treasury Department is supposed to, at least, on the 8th business day of every month, report the previous month's deficit numbers or surplus numbers, or, how much income they took in through taxes and fees and how much they spent. Okay? 8th day of every month, that's supposed to come out, 8th business day. Well, that turned out to be, for the month of August, that was like September the 9th or 10th or something like that. And that day, the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. And hell, for me, it was like, what? In a month? $380 billion? And I think that kind of, if you're a fiduciary managing retail money, hedge fund money, whatever, that was kind of a shaky by the lapels moment. Like, wait a second, this is really getting out of control. And gold has moved up about $150, $200 since then. And I think, so I kind of got this combination of factors that just keeps putting a bid under gold. And
in today's news recap, Russia in talks with BRICS over precious metals exchange. Russia is in talks with other BRICS members about creating an international precious metals exchange to ensure fair pricing and trade growth. The country's finance minister, Anton Siluanov, said in a statement on Thursday. Leaders of BRICS countries, which account for 37% of the global economy, gathered in the Russian city of Kazan this week to discuss initiatives aimed at creating alternatives to the Western-dominated financial and trade infrastructure. The mechanism will include the creation of price indicators for metals, standards for the production and trade of bullion, and instruments for accrediting market participants, clearing, and auditing within BRICS. Siluanov said. The BRICS Precious Metals Exchange would rival Western trading platforms such as the London Metal Exchange and would protect trade from sanctions imposed by the West on BRICS members Russia and Iran. Earlier, BRICS leaders expressed support for efforts to increase trade in precious metals among the group's countries in a joint communique issued on October 23. Russia is the second largest global gold producer, and one of its biggest companies, Nornickel, is the world's largest supplier of palladium with a 40% share of global output. All major Russian gold producers are under Western sanctions, which have also hampered Nornickel's operations and its palladium exports, although the company itself is not under direct sanctions. Nornickel and the country's largest gold producer, Polyus, declined to comment on the initiative. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
And again, on just straight total amount of contract open interest, we're not at anywhere near historical extremes. Even in silver, which now, has taken off in the last couple of weeks, total open interest in silver is 150,000 contracts or so. You can go back to May when silver first broke out and was traded up around 32 and 33. We were about 190,000 contracts. So we're still 15, 20% below?
Yeah.
Even that peak. Now, positions have gotten more concentrated. The net short position of the, you want to call them commercials or the swap dealing banks or whatever, those positions gotten pretty high, almost historically high. The net long position of the hedge funds and the speculators, that's getting up there too. But that's the funny part. It's not like there's been some big, huge rush of new hot cash that has come onto those exchanges. And so that's another peculiarity of all this. You mentioned no real pullbacks since about this time last year. It was early October when it all seemed to, in a way, I think it's just coincidence, but you had the Hamas-Israel thing began on October the 7th. And that was about the time that gold started to take off, was in early October. And it was about $1,850. So we're 50% higher. But it has been like any classic bull market in anything. NVIDIA, whatever you want to pick, is just a series of higher highs and higher lows. you get these pullbacks to the 50-day moving average and you get a bounce and then you move higher. And you can see this in the gold shares as well. So it's really on any level, it's pretty healthy setup. The thing that I think concerns me after have been doing this for so long is that concentration of positions. You can look at the, say, just the swap dealer position, as we call it, the swap dealers, which are, what are swaps? They're derivatives. Who deals them? The banks. So when you see that category on the commitment of traders report, we're talking mainly about the bank trading desks, the big bank trading desks. And they're net short. Well, we'll see what they are in the next survey, but 40,000, 50,000 contracts of silver net short. Well, that's a couple 100 million ounces. So every dollar that silver goes up, that's a paper loss of a couple 100 million bucks. And that adds, pretty soon you're talking about that's real money, right? I worry that those positions get so stretched and extreme that you start seeing some shenanigans to try to get the price back down. But for now, like I said, we seem to be doing okay. Actual numbers are, if it's significant enough, that story is a little bit like the Samsung battery story. Remember that from a month or so ago? And these are real stories. I'm not trying to downplay them, but this idea that this new battery is going to soak up a couple 100 million ounces a year of mine supply. Okay, yeah, it might, but it's not like next week. And the idea that Russia is going to start adding silver and other metals to their foreign currency reserves, like they've been doing with gold, that's great. But I kind of need to see, and then when you get the reporting, is it accurate? Is it honest? But if they are, again, anything that soaks up physical supply and forces even more leverage into this fractional reserve pricing scheme we have, stresses that system. And I think that's what we're all waiting for, is the reemergence of some sort of level playing field pricing where price is discovered. You can use a little bit of leverage, okay, but 100-to-1 leverage or whatever it is that's not a fair pricing scheme. So anything that can force a deleveraging of the system, and it's that physical bank run kind of thing that will ultimately do it. Anything that leads us down that path is a good development.
What do you think about Craig Hemke's insights on gold's upward momentum and silver's recent catch-up? Craig highlighted that central bank demand for gold has hit record highs, with countries around the world, especially in developing regions, adding more gold to their reserves. This steady buying trend, along with rising U.S. deficits and economic uncertainty, makes both gold and silver strong candidates for future price increases. Let us know what you think about Craig's predictions in the comments below. And don't miss our next video for more expert insights on the precious metals market. It's the perfect follow-up to today's discussion. Thanks for watching, and we'll see you in the next one.